Jean-Pierre is very well known. He has worked for many years in the insurance sector in France and in many countries, including, including the Balkans for the so-called TAKIS program, that was an EU-funded program for technical assistance to the CIS countries. He has been collaborating with a consultancy company which worked for banks and insurance companies when bancassurance started in France and later in other European countries. This was the starting point of his interest for bancassurance, a distribution channel which he described in 2 books. Very good, Daniel, very good. Besides his consulting activities, he collaborated with the master degree Banque Finance Assurance of Paris-Nanterre University and the École Nationale d'Assurance in Paris. So, Jean-Pierre, you have the floor.
Okay, thank you very much. Thank you very much, Carol, for this very nice presentation. Thank you very much to the association to invite me. Thank you very much to Daniela as well to invite me, to give me the opportunity to visit Baku, a city which I didn't know, which I appreciate very much yesterday. So I shall try to present you what has been the success of bank insurance in France. But I just want to say that it is not, it started in France, but it expanded in the southwestern European countries, Spain, Italy, Portugal, Greece, before the crisis. So, right. Okay. On this table, you see something which is very, very simple, the distribution channels in France for insurance. On one side, you have the non-life, where you see that banks have 18% of the market, and in life, they have 64% of the market. And you see later on, all of the other distribution channels, the agents, which are very strong in non-life, but who are very weak in life, the brokers, strong in non-life and weaker in life, the direct, which is something very French, so I do not insist very much. But what you have to remember is that the non-life insurance in France is sold at 19% of the non-life insurance is sold by banks, and 64% of the life insurance products are sold by banks. Funny. What is the trick? Ah, the starting point. At the end of the 70s in France, life insurance market was very underdeveloped with respect to other European countries. I'm speaking of England and Germany, Netherlands. In France, we were very, very, very underdeveloped in terms of life insurance. And this was the same in Spain, the same in Italy. Perhaps if we had time, I could come back on this topic. But just remember that we were a country where life were very, very underdeveloped. The banks have been very clever to create, so you've seen that I've quoted create, they have created a new insurance product. And thanks to this new insurance product and to their network, they have been very, very successful in France. The reason why this product, which I'll come back in a minute, has been very successful because it looks very much, it's an insurance product, but it looks very, very much as a banking product. I still don't understand how this works. The one in the middle? Yeah. And to come back. Okay, sorry. This new product, the name, the official name, the actuarial name is a deferred capital with counter insurance of the premiums. Of course, if you use this name to try to sell this product to a customer, you're sure not to be able to sell the product. The name is absolutely, nobody would understand, no customer would understand what is a deferred capital with counter insurance of the premium. So the banks never use this word, and they said only it's a financial product with tax advantages, because at that time, life insurance had some tax advantages con respect to the other saving products sold by banks. So this product is very simple. You promise to your customer to pay a capital after a period, 10 years, 15 years, 20 years. Today, there is very often no limit. The capital is built up with, of course, premiums, which can be regular premiums, where the bank obviously have an advantage, or lump sum, a single premium, which is paid if somebody has an heritage or something. It can bring 50,000 euros, 100,000 euros, and very often much more than that. The promised capital, I said, is paid after a while. The premiums maybe then are invested, of course, by the insurance company in products which are more or less sophisticated, depending on the type of customer you have in front of you. If the customer wants to have a lot of security, you will obviously invest in bonds. If you have a customer who is not so risk adverse, then you invest the money in shares with a more risky activity. The question is, the customer say, okay, you promised me to give me this capital after 10 years, after 15 years, but what happens if I die during this period? No problem, no problem. The money you have invested, not the capital promised, but the money you have invested at that time will be paid to your heirs. So there is absolutely no risk. So you understand what I meant before that. It's an insurance product, no doubt about it. It's regulated by the insurance supervisory authorities, but it looks very much as a banking product. And obviously banks at the very beginning didn't explain to their customer that it was an insurance product. Again, a saving product with tax advantages. The results, that's what Carol mentioned a minute ago. I like very much this table. In 1985, the turnover of life insurance in France was 11 billion euros. And the banks had 1/3 of this 11 million euros. 10 years later, the turnover has been multiplied by six. There is very few products which are 2 centuries old, this life insurance product, which have grown so quickly in such a short period. 6 times, and of these 64 millions, the banks who had only 30% 10 years ago now have almost 60% of the market. So that's, well, you can really call it a revolution. It's a very strong change in the distribution channels. And then later on, you see that the banks are still growing. In 15 years, they have duplicated the turnover, but logically, the growth is not so strong. But today, even today, banks are growing by 1 point, 2 points, but they are still growing. What are the product benefits? It's a product very easy to understand for the customer. You save your money, after the end of the period, you receive your money. If you die, meanwhile, your heirs receive the money. Very simple. Very simple for the customer, but as well, very simple for the salespeople of the bank. It's not very complicated to explain that to a sales network. A product which is very transparent. That's a very important point. The banks, they wanted to be different. And one of the things in which they were different was to tell to the customer what are the costs of the product. In all our policies, not only in France, in all countries of the South, In all the policies, when the customer invests 100, he sees immediately what percentage of this 100 has been converted in mathematical provisions. And the percentage is very, very often 95%, very often 96, 97, in some policies, even 100% of the money invested by the customer is given by the customer to the insurance company is invested by the insurer in mathematical premium. So it's very clear for the customer, you exactly know what is the cost of your investment, which is a big difference with the products we had before in France and that you may have in your countries, in which the customer do not know what will be the cost of its investment. As I said, mentioned, single premium, regular premium, absolutely no problem. You can start with regular premium and then if you have a lump sum, invest this lump sum and come back afterwards to regular. It's extremely, extremely flexible. And again, very wide range of financial sophistication. So that is, we are now in 80, 85, 90. Banks were very proud because, you know, banks and insurers are like dogs and cats, at least in France. Banks were extremely proud to have had this success in life insurance. And they say, well, if we have been so successful in life insurance, we should start in non-life. But some banks were more clever than others and say, well, the problem is that in life insurance, you don't have claims, or at least you don't have claims management. The people die, the people want their money, no problem. In non-life, you always have claims, and all claims are not always settled perfectly. If a bank, because the customer knows the bank, he doesn't know that he has an insurance, there is an insurance company behind. He sees the bank, and if the claim is not settled properly by the bank, really, you know, all of us know that it is an insurance company, but in fact, for the customer, the bank who sold me the product doesn't settle my claim properly, I may leave the bank. And of course, for the bank, this was a danger, and they were extremely cautious on that point. So the banks were reluctant. We had an exception. Well, I don't mention it I just mentioned it here. It doesn't matter. The main point is in 95, Le Crédit Agricole, which is one of the most important retail banks in France, which had been very successful in life, decided to start in the non-life market. And they have been successful. And today we have two banks which are really, really successful in non-life. We have les ACM, the old one, and Le Crédit Agricole. Today, Le Crédit Agricole Assurance is the largest insurance company in France. I repeat, the bank, because it is a bank, is the largest insurance company in France. And then after that, in the years 2000, 2010, most of the banks are now selling non-life. They are not as successful as the two leaders, but all French banks are selling, except very, very few of them, all banks are selling non-life insurance products. They have not entered, what I mentioned here, they have not entered yet in commercial lines. If you look at the strength of what I call the French insurance model, you look at the benefits for the bank receives the commissions of the insurance company. The dividends paid by the insurance company are paid to the shareholder of the insurance company, which is the bank. And the bank manages the mathematical provisions of the life insurance company, which is its subsidiary. So you have, I would say, three possibilities of three profits for the bank: the commissions on one hand, the dividends, and the profits made out of the management of the fund. There is one danger. It's what we call cannibalization. 70%, perhaps 80% of the premiums of the insurance companies are coming from the deposits of the bank. So, as you know, a bank needs deposits because with the deposits you make the loans, and the business of the bank is to make the loans. So you may have a conflict, and I will explain you in a minute why the French insurance model is, in my point of view, the only way to settle or to avoid this type of conflict. These possible conflicts of cannibalization, which is a very, very serious, which has been in the past a very serious issue, are settled in this model by the fact that the shareholders of the insurance company and the shareholders of the bank are the same men or women, mainly men. But the shareholders are the same, so that the strategic decisions are taken by the bank, the insurance company obeying, to say it that way, to the strategy decided by the bank. So I think I skipped one or two slides, but then I respect my timetable. I just wanted at the end of this presentation, which has been very short, but I can answer questions if you wish, or if Carol asks me some questions later. I just show you a few pictures. This one is not very good because you don't really see, but on the window, those are closed, see that it is Banque et Assurance, la Société Générale. It's easily to understand that it is a bank. On this slide, this picture is much better. This is Le Crédit Agricole, and you see on the facade of a bank agency, you have Banque et Assurance. That's what I meant. I mean, the banks now have two legs. On one hand, the banking product, and on the other hand, the insurance product. I think, and you see it as well, I think, in the last one, which is Le Crédit Lyonnais. You see, this is the emblem of Le Crédit Lyonnais, LCL, and you see Banque et Assurance. They are equally important for the, at least for the retail banks in France. I have been very short, but I'm sure Carol will ask me some questions afterwards, and that's fine. Many thanks for attention.
Thank you very much, Jean-Pierre, also for keeping the timing. But if you could stay on for a minute, you very interestingly pointed out that a number of financial operators in France, as the Crédit Agricole, are both bankers and insurers. Now, banks are regulated in one way,
and banks in other,
and insurance companies are regulated in a different way. If you put these two together, what do you get? Do you get some kind of tomato soup, or what's the result of that?
No, first of all, you know better than others that the regulation in France is run by a single body, which runs on one hand, regulates, on one hand, the banks and the insurance company. The same administration, the same civil servants are regulating in the same entity, regulating banks on one hand and insurance companies on the other hand. No, I think it's very, very closely. What I've not said, I'm sorry, because one, I wanted to be short, and second, I'm so much involved that I thought that obviously insurance companies, they have a shareholder, which is a bank, but the insurance companies are insurance companies, 100%, totally separated, of course, of the banks. And like in any of our countries, you have a life company, you have a non-life company, and we do not have conglomerates in Europe, in the EU. So no, I think there is no problem. They are really separated. The only thing which I think is very, very, very important is the fact that as you have only one single shareholder, you avoid the conflicts which we have seen in other countries, because when I come back to cannibalization, when the bank is very, very, very successful in selling insurance product from a real insurance company, which has no financial links with the banks. What happened in England, to a certain extent in Germany as well. If the bank is very, very, very successful in the first time, but in selling, the bank receives a lot of commissions from the insurance company. Everything is fine. But you get a time in which the problem which I mentioned, the cannibalization, happens. You know, the bank sees that its deposits the deposits of the bank are transformed in mathematical provisions of the insurance company. And you have a conflict. And that's why in some countries, I'm thinking of Finland, bank insurance is not as developed as it is in France.